Many of you would have seen last week, QED investors and Boston Consulting Group released a report focused on the future of fintech, the global future of fintech, and it was really, I felt like, fascinating reading, a rigorous analysis of the current data, sort of extrapolating it out into the future. So we are honored today to have with us the co-founder and managing partner of QED Investors. Please give a warm hand to Nigel Morris. Nigel? Thank you, sir.
I did not choose that music, Peter. Good morning, everybody. About a year ago today, I was on the stage here with David Velez, the founder and CEO of Nubank, talking about how to build a company out of the ground. So, Peter, thanks much for having me back again. I think you're a glutton for punishment. Today's a very, very different agenda, because today I'm really looking forward to jumping into a study that BCG did with QED on the future of fintech. And a word quickly on QED, and I don't want to give a soap commercial. We're a global, dedicated fintech investor. We've been doing it for 15 years. Frank Rotman and myself started. Oh, by the way, Frank Rotman is giving a talk tomorrow on why venture capital is broken. I think it's tomorrow on the agenda, 11 a.m. Please go along and cheer Frank on. He's got some really incredibly cerebral thoughts about the nature of investing in venture. 15 years. We've been doing fintech before fintech was a label. We only focus on fintech. We're active all stages in starting things. We were in very early at Nubank and at Klarna and at Credit Karma. You can see some of the companies on the right there, Remitly and Mission Lane and Kavak and Quinto Andar. We are global in reach. We really believe there's huge opportunities in other geographies, and the ability to take an idea in geography A and move it to geography B creates enormous comparative advantage. We've made 200 investments in 15 years, and that's what we do. When we were having conversations with our investors, one of the questions that they asked and were wrestling with was, where are we in this fintech evolution or revolution? Are we, on the one hand, in the very, very early stages? There's been a lot of breakthroughs, but there are massive breakthroughs yet to come. Or are we in the final stages of the book, in that the low-hanging fruit ideas have already been adopted and taken down? The Squares and the Stripes and the Klarnas and the PayPals have already occurred, and now it's advantage incumbents, and fintech is now a spent force. So we set out to really wrestle with, are we chapter 2 early or chapter 8 much later in the process? And we talked to our friends at BCG, who said, wow, this is a really fascinating topic. And what we're going to talk about today is the first time in my experience, and I've been involved in financial services now for nigh on 40 years, probably longer than many of you have been on this planet, but the first time that we have a top-down study of financial services, and at the same time a bottom-up, and looking to join the two ends of the tunnel to try to make sense of it. So what BCG did with QED is that we did over 100 interviews with incumbents, with fintechs, with venture firms, and other people who were very active in the community. And the question was, where are we in this journey? And are we likely to have those breakthroughs, or are we really in chapter 8? So you all know this, but fintech has had an amazing journey. Since the onset of QED now 15 years ago, it was basically up and to the right. Fintechs were growing, they were capturing share, they were satisfying customers, they were working on their unit economics, their valuations were going up. And as you can see here, the public valuations skyrocketed, money came flying into the system, to the point where of the top 10 most valuable financial institutions in the world, 2 of them were fintechs, Ant and PayPal. And we have over $500 million that's investing that's gone into fintechs. And of course, you know, many of them have got a huge amount of traction as they went forward there. So we see, we saw a huge amount of money going into crypto 3 years ago. Talking about crypto with investors is borderline radioactive at this point. And you're all here listening to conversations about ChatGPT and AI, which everybody is talking about. And the question there is, you know, how does that actually create huge value for customers and in building businesses? So $1 in $5 in venture was going into fintech, and we saw this incredible energy of fintech. Now, 3 years ago, the world changed. 3 years ago, we were all worried sick, no pun intended, about COVID and how bad it was going to be. We were all predicting a recession. Of course, the government stimuli put us in a position where that did not happen, and the recession that people were predicting did not happen. But what did happen was a step change function into digital. Businesses that previously were delivered analog or face-to-face were now being cannibalized by digital business models, and they were emerging really fast. A great example is one of our portfolio companies, Remitly, a digital money mover from developed to developing countries. They found that a lot of people who were being served by the Western Unions of this world and their services being done face-to-face were now willing to make the Promethean leap to now be having those services done digitally, faster, much better net promoter scores, and for a third of the cost. And when people cross that Rubicon toward digital, they don't go back to analog. So when that started to happen, we're now 2 years ago, we saw a huge amount of FOMO in the market. And we saw a huge number of firms, hedge funds come rushing in to fintech and betting on the future from an investment perspective. And you can see here the revenue multiple that was running for the longest time at 6 or 7, then was bid up to a maximum of 20, and then I don't need to tell you, in the last 2 years it's come crashing down as we've moved to a normalization or an old equilibrium. Now, financial services is between 20 and 25% of GDP in just about every country in the world. We also found that from a profitability standpoint, financial services are better than real estate or energy or construction, manufacturing, etc. So it's huge, one, and two, it's really profitable. The margin is 18% on financial services in general. It's higher for banking than it is for insurance, something like 30% to 6 or 8%. And remarkably, and this was a stunning number to me, I don't know if it stuns you, but the financial services worldwide is $12.5 trillion in revenue. $12.5 trillion. And if you use that 18% margin number, the profitability of financial services worldwide is over $2 trillion. I think I have it there, $2.3 trillion, which actually is higher than the GDP of Italy, and just behind the GDP of France. So this is an enormous business, and I think it was shocking just to see the size of it and the magnitude of it. Now, so this business is big and extremely profitable, and therefore a very, very rich target potentially. Now, we also look at how have the fintechs done and how are they really competing as we start to look at where the opportunities are as we wrestle with the Chapter 2 versus Chapter 8. Here are net promoter scores of some of the public companies that you know. SoFi, Nubank, who will release earnings on Monday. We see Affirm, Lending Club, Funding Circle. And you see net promoter scores in the 80s and above. Pretty much all of QED's portfolio companies would be 70 and above. The incumbents at 23. And they're doing better. As they've started to measure net promoter scores, they've been focused on it and targeting on it. The actual net promoter scores of the top 4 is actually 15. And 1 or 2 of them are in single digits. So what that tells you is that fintechs start with what's the problem that the customer has, be it SMB or be it an individual, and work backwards to provide a solution to that, rather than I've got this distribution system called my branches. How do I get you to come in so that I can service you and sell you stuff? Banks have historically started with a distribution-oriented ethos rather than solving an underlying problem. So as you look at these kinds of net promoter scores, you've got to be saying to yourself, look, fintechs really are liked at a much greater level. They may not be trusted in the same way. That's a different issue. That is wrapped up in FDIC insurance. But in terms of meeting a customer where they are, you can see the data. So much of digital rode on the back of the wave of all of us having mobile phones in our pocket and looking at them all the time. But there are many, many, many emerging technologies that are going to catapult fintech into chapters 3, 4, and 5. And these were the themes that came up in the conversations that we had in the interviews. I'm not going to go through all of them. We just heard about generative AI and neural nets, API connectivity. There's some evidence that actually generative AI will enable and allow people to write apps. 10 years ago, if you could construct an app, you were an IT rock star. Now it's becoming much more de rigueur. Decentralized ledger technology and blockchain still has not yet met its promise, but the promise is still there, and the molecular building blocks around blockchain are emerging. Quantum computing, reducing costs, going up to the cloud, and then I think really, really importantly, embedded finance, and how, as just about anything in this world that is analog or paper-based or high friction, will over the next decade become digitalized. And as it becomes digitalized, you have a customer, you have an opportunity to sell and to cross-sell, and you have the ability to offer payments, lending, and insurance at that time. So these, I think, are some of the meta-themes that exist. Now, in the study we did with BCG, that 12.5 trillion, and you see it's about 50-50 with insurance and banking worldwide again, the projection is it'll grow at 6% per year until 2030. So 12.5 becomes just under $22 trillion. Now, as you might expect, fintech will gain share rapidly. Fintech today is $245 billion on 12.5 trillion, which means that fintech, notwithstanding all of us and what we do, is 2% of worldwide financial service revenue. I'm not making a mistake there. It's 2%. Now, it will gain share. Here we're seeing 245 billion projected to go to 1.5 trillion. So it gains share and goes up by 22% when the market en masse goes up by 6%. And then if we look at the penetration levels by banking revenues, you can look at that, and valuations. Fintechs will have much greater share of financial service valuation, going from 9%. So fintechs today have 2% of revenue, but 9% of valuation. They'll go up substantially to the point where they'll have nearly a quarter of all financial service valuation by the year 2030. Now, that growth in fintech that's projected is not going to be, on average, everywhere the same. It differs substantially by product, by geography, and here we're seeing geography. North America will go up 4x from where we are today, the average being 6x. LATAM, where QED has had a terrific experience, and we ticked off some of those companies earlier, will grow at 12x. Europe, 5x. The Middle East and Africa, still almost a blank slate, tabula rasa, 13x. And then APAC, 8.5x. Much of APAC being India, of course, Malaysia, Thailand, and of course, China. So we really are passionate believers that if you're in the investing game, you have to have a global outlook, because the opportunities to create the new bank of Nigeria or the Stripe of Indonesia are very much going to be those opportunities over the years to come, learning from and building off the shoulders of the companies that have come before. In so many ways, Nubank is rather derivative, and David Velez and I talked about this a year ago, of what Capital One learned. So much of Nubank is accelerating technology and mindset from the learnings around credit risk in the Capital One days. So it's not a shoo-in, though. It's not going to happen automatically. And as in the conversations, many people were very comfortable saying, look, here's what we worry about. Here's why these projections might not happen. And here are the issues that we're going to have to navigate. So first of all, any new technology, any new business models are going to be beholden to the regulatory stance around them. Certainly in conversations that we have had with regulators in Singapore or in India, they're very much focused on embracing digital as a major force in their countries. Why? One, because it has a multiplier effect. It gives access to people who do not have access today to financial service products. And two, it allows you to be able to regulate the black economy and take cash out of the system and be able to digitalize the whole process. So what really clearly in the study was, what is the role going to be, particularly in the US, of regulators creating more clarity so the guide rails of innovation can be within those guide rails, rather than waiting for a fintech to do something that the regulators don't like and then have to go back and punish people for decisions that they made when they were doing it in the best intention. That regulatory overreach is there. The regulatory process is not apolitical. There are issues that emerge through regulation that is influenced by policy and by Washington. I live in Alexandria, and I can't throw a stone now and not hit a regulator or a lobbyist involved in financial services. So huge issues there around how to manage a very complex and, you might say, sort of incredibly layered regulatory system. Reputational damage. You've all seen the issues that have emerged over the last year or two in the crypto space, and how that has damaged financial services in general, and how, in particular, around the fintech space. How do you govern, and what is the role of venture, and what is the role of regulators in that process? And we only have to go back to SVB and FRB in the last month, and how that's gone. Big tech encroachment. Big tech's got some really powerful comparative advantages. Loads of data, a great technology, ability to build things really fast, embedded opportunities and windows to do things. Their worry is that they don't want to be regulated like a financial institution. So how does that emerge, and how does that partnering come together? And lastly, interest rates continue to move up. Your guess is as good or better than mine as to whether or not we have reached a plateau, but clearly we're still fighting the monster of inflation. There was a good number out this morning, by the way, I don't know if you saw it, at 4.9%. So look, key risk issues to wrestle with as we go forward. The incumbents must embrace the fintechs. I've said this many times, and I hope it resonates. Banks cover what the fintechs have, and fintechs cover what the banks have. What does that mean? Fintechs have verve and energy and unit economic focus and focusing on a problem and the ability to be really native and aggressive with building out apps. They can test and learn really rapidly, and they can get really spiky talent into their organization that's incentivized through equity. The banks have regulatory and compliance expertise. They have deep pockets, profitability. They have brand. They have proprietary data. And indeed, they have the ability to mobilize vast infrastructure. But today, they're talking past each other often. Banks are reticent to engage with fintechs and don't know how, partly because they're very focused on, are we going into a recession this year? And it's very hard for organizations to focus on more than one single thing at a time. But my advice to the C-suite of the banks when they invite me along to talk to them is that you cannot put your head in the sand here. You've got to be engaging. You've got to be focusing on how do you partner? How do you learn from? How do you learn with? How do you create windows where you can acquire? How can you push fintech ideas through your distribution channel? We've seen a key bank do a terrific job of that, by the way, with Avid Exchange. How can you, the value-added chain is starting to bust up. In the US, pre-COVID, there was a mindset in the incumbents that said, look, I can do it myself. We can build the technology. Most of this fintech stuff is a flash in the pan. Now, as a result of the plaids of this world, the incumbents are much more willing, the more sophisticated ones for sure, to bust up the value chain. And the value is going to be, how do I join up various fintechs together? So it's an example of a portfolio company called Treasury Prime that basically joins banks and fintechs together. They're the connective tissue. And in that, take away a lot of the risk for the banks and enable the fintechs to be able to grow. Fintechs need to tighten their belts. The challenge is that we're going to an austere environment. We've worked so hard over the last 18 months, 2 years, to actually reduce the cost structure of our portfolio companies so that they can maximize the runway and provide that opportunity. So we should not get overly concerned about the short-term perturbations, because we believe that the meta arc, the big picture, is that we are fundamentally in Chapter 2. In many geographies, for example, we're still in the prologue. And the opportunities leveraging technology and the capability that we talked about earlier is going to fire up dozens and dozens of PayPals and Klarnas and Nubanks and Credit Karmas going forward. So with that, that's the study. Please download it. You can find it on our site, or if you Google BCG QED, you can have access to the study. I'd love to hear your feedback. It's certainly directionally exciting. And of course, I, like many of you, do have a dog in this hunt, and I'm really excited that it came back very much that there's many more breakthroughs to come. So with that, thank you very much for listening to me, and I enjoyed it very much. Thank you.